Hi guys, it's Dr. Robinson. This is the July 15, 2023 meeting of the Money Masters Investment Club. Not a lot to talk about here. There is one thing I wanted to talk about in a little bit of detail. We'll do our financials first, so let's kind of get to that. As far as the financials go, our NAV on 7/7 was $29. The NAV on 7/15, $29.42. We had another pretty good week overall. So, and I expect that is going to continue going forward. So overall, pretty good week. There are some things I've been getting some calls and texts and things about. Is it time to get back in the market? The market is approaching some record highs, especially on the S&P. The record high of the S&P, I think, is somewhere in the neighborhood of 4,800, and we're now at about 45 something, 45 and some change, close to 4,600. So at the end of the day, we're really close to some record highs. And I personally don't think the economy justifies these kinds of markets. Now, a lot of that, the giddiness that's in the market comes from the belief that, from a lot of people, that the Fed is done raising interest rates. Now, the Fed has a meeting this month, and I do expect them to raise interest rates 25 basis points this month. They originally said in their last meeting that they expect 2 more interest rate increases this year. I'm not convinced actually that there will be a second one. I don't know that we need a second one. The recent readings on CPI, PPI, and PCE don't really support the need for it. However, there is something I'm watching that kind of could change that, could materially change that decision, and we might see some actual significant increases in interest rates later in the year, even into 2024. So there are some things on the kind of storm clouds, if you will, that are on the horizon that could change that view. But for the moment, as we sit here right now in July of 2023, I don't see that much in the way of interest rate increases beyond the next 25 basis points. But keep in mind, that could change, and I don't have a crystal ball, it's just an opinion. But what I am telling my clients is it's not necessarily time to go all in. I've got some clients who are saying, is it time for me to kind of get rid of all my money market stuff? Is it time to kind of get rid of any bonds that I might have? Or if I have a bond that's maturing, should I put the money back in a new bond where the interest rate is still pretty attractive? But if interest rates keep going higher, you're going to start losing money on those things. What do they do? I'm not convinced yet it's an all-in position yet. I'll tell you why. So I'm saying don't fall for the hype. You hear all the talking heads on TV, a lot of people talking about stuff on YouTube and other things. I'm not in the camp of it's time to get all in the market. I still think that there's some caution to be warranted here. So here's why I hold that view. Right now, Forex traders, now Forex stands for foreign exchange. These are the people who buying and sell, not like, they kind of like do options like we do, but instead of doing options, stock options or index options or whatever, they do it with money. They do it with currencies. So they may trade the US dollar against the Canadian dollar or the US dollar against the euro or the Japanese yen or something. So they're just playing with money. So of course, when you're playing in the currency markets, you want to buy a currency. It's like buying stocks at a low. You want to buy a currency that's low in the hopes that it will go higher in the future. On the other hand, when a currency gets too high, you want to sell that currency because you want to take your profits from it. Maybe you bought the currency at 85 cents and it's now worth $1.15. Well, in that case, it's run up a pretty good amount. So it's time to sell it. Take your profits, sell that currency, and look for a different currency to buy. Or you could actually short the currency you had that's at this high. That's a common thing. So you could short, let's say, the US dollar for the euro. Maybe you think the euro is going up, but the US dollar is going down. So you could short the euro. You could go long the euro. Whatever. Or, I'm sorry, I said short the euro, but I meant short the US dollar versus buy the euro. There's a lot of different things you can do. It's no different than any other type of investment where we buy and sell things. It's just you're buying and selling currencies as opposed to stocks or bonds or whatever else. Well, right now, Forex traders are selling the US dollar. And they're selling it against the major currencies, the euro, the yen, and the British pound. Now, those are the 3 biggest currencies other than the US dollar in the world. So the question becomes, why are investors selling the US dollar against the euro and the yen and the British pound? The reason for that, I think you can see it clearly in a chart I'm going to show you here in just a second. So let's kind of look at this. So you can see in a Forex chart of the US dollar why investors may be interested in selling the US dollar. And it comes to this chart right here. Now you can see in early 2021, the US dollar was at extreme lows. The dollar was actually only worth 89 cents at the time. So that means for every dollar you had in your hand, if you have a dollar bill in your wallet, that dollar bill was really only 89 cents. That's where inflation comes from, by the way. When the government prints so many dollars that the value of a currency falls, it takes more dollars to buy something, and that's why we have inflation. So this was the beginning of the inflation run we had, where it started taking more and more dollars to buy things. For example, if something in 2021 cost $1, but the dollar in your wallet was only 85 cents, what you had to do is you had to pay somebody $1.15 to buy something that was only worth $1. So you're paying an extra 15 cents just so that the seller, let's say it's a shopkeeper, the shopkeeper wants to sell you something for $1, but if you lay down $1, they're losing 15 cents because you just laid down 85 cents. So they want you to add an extra 15 cents to that to bring it up to $1. So instead of buying something for $1, you're paying $1.15 for it. That's why we call it inflation. You're inflating the currency, and because you're inflating the currency, you're making the value of your current dollars less valuable. Well, as time goes on, things start to happen. COVID happens really bad, or really starts bad at this point here. The economy's been shut down for a while. The economy started getting shut down in 2020. Now it is starting to open up a little bit by 2021, but not very fast, and certainly not at places like restaurants and movie theaters and all those other places where people have a tendency to congregate. So the economy is still struggling, and it's not just a U.S. economy issue that's struggling, it's a worldwide. China is struggling, Korea is struggling, of course, Japan and Europe, and all these economies are on the brink. Well, when you have fears of a global turndown, where do people want to put their money? Do you want to put your money in, let's say, a German bank where they're charging you 2% to put your money because they had a negative interest rate at the time? Or do you want to put it in an American bank that's paying, maybe you put it in Bank of America or Chase where it's paying 2%, or maybe even only 1%, but 1% positive is better than 2% negative. So what happens is that people get scared and they start flocking to the US dollar. So they start buying dollars. So Forex purchasers, they started buying the dollars. They were selling the yen, they were selling the euro, they're selling the British pound, and they're buying US dollars. And they're certainly selling some of those Asian currencies like the Korean won or the Chinese yuan, also known as the renminbi. So they're selling those for the US dollar. Well, as more and more people buy the US dollar, the value of the dollar goes up. Remember, in basic economics, the greater number of buyers of something, the price of that thing goes up. And the price for a dollar is just, the fact that a lot of people want the dollar. So it drives up the value of the dollar. So you can see that all through most of 2021, the value of the dollar is slowly creeping up. It gets up to, say, 90 cents, 91 cents, 92 cents. Now, the scale on this to the right, by the way, this is done in the way currency investors do it off of a block of 100. I just go by the actual value of the dollar itself. So the dollar started in 2021 right around 89 cents per dollar. So think of it as like 11 cents discount on the dollar. Eventually it gets to 92 cents and 93 cents, and eventually it gets to, say, 99 cents, and even gets to $1. Gets to $1 about March of 2022, so a little over a year, maybe a year and 3 or 4 months ago. And then it starts to spike a lot. Again, there's a lot of fear in the global economies about world economies, so in recessions and stuff. So more and more people start turning to the US dollar. Again, a lot of foreign countries, especially the two biggest when it comes to safety for the dollar, is one of them is Japan. The euro is also, but one of the problems with the euro is that there's a lot of countries in the European Union that, as I said earlier, had negative interest rates. So if you're in Germany or anywhere near Germany, you didn't want to put your money in a German bank because there was a negative interest rate. Well, the same was true of Sweden. Finland had negative interest rates for a while. So there weren't a lot of places you could go to get positive interest rates. So again, you either have to turn to a British bank, but they did have positive interest rates for a while, or you can come to the Americans. So in the United States. So at the end of the day, a lot of people are still buying US dollars. Well, that peaked It peaked in about October of 2022, where we saw the value of the dollar hit 115. Now, and this, of course, because it's based on 100, it says 115, but it's $1.15. So the dollar went from a value of 89 cents to $1.15. Now, again, the value of that goes up because of the demand of those dollars. The problem here is that a lot of that demand is outside the United States. Well, eventually, the people who bought that dollar decided that it's time to get rid of that dollar. Now, as more and more people bought the dollar, inflation started. Remember, inflation is caused by too many dollars. Well, now you've got a lot of dollars in circulation, and they're not kind of all being used in one place. So the value of the dollar goes up, inflation starts to come down a little bit. So, in fact, if the dollar is now worth $1.15, but you want to buy something for $1, well, the price of that should be like 85 cents. So it should be working in the reverse. It doesn't always, and we've seen a little bit of that now, although prices for something, for example, eggs have come down. They were really high for a while. There was a period of time where when I went out to buy a thing of 18 eggs, it was like $7 or $8, and I bought them just a couple of days ago for $1.65. So the prices of them are coming down. So prices are starting to come down. Now, I'm not talking in terms of deflation, by the way. This is just simply called disinflation. We'll talk about the difference between deflation and disinflation in just a second. But what I want you to understand is the value of the dollar has come up all the way to 115, but since then, it's been starting to come down. Now, is this problematic or not? And the answer to that is it can be. And here's why it can be problematic. As prices or as the value of the dollar comes down, the more people who sell that dollar is going to cause that dollar to come down even faster. And remember, most of the commodities we do in the world, gold, most precious metals, oil, those things are bought and sold in US dollars for the most part. Now, it's not always true. There are some countries trying to get away from it. Russia, of course. Russia does not want to buy oil in US dollars. They don't have that ability now because they're being restricted because of the Ukraine war. China does not like the idea of buying oil in US dollars. So they've tried to make a deal with Saudi Arabia to buy oil in their own currency or in a neutral currency. They just don't want to use US dollars. As more and more of the world goes away from using the US dollar, we're going to start to see the devaluing of the US dollar. So as the value of the US dollar comes down, what's going to happen to that? Or what's going to happen to the price of commodities? So the question really becomes, what does any of this have to do with equities? Well, the reason I say we're getting premature, or some people are premature on all in on equities, is because as we go through this disinflation, and remember, it's not deflation. Deflation is a general decrease in prices. We're not seeing that. Things are still more expensive. They're just less more expensive than they were. For example, the inflation rate is still 4.8. The Fed is trying to get inflation to 2%. They like 2% inflation. So they like to devalue the US dollar by 2% every year. It's manageable to them. Well, right now, the inflation rate's 4.8. That's more than twice what they want. But it is also half of what it was. It was at 9.1. The high in the inflation rate was 9.1. So if you went from 9.1 down to 4.8, it's still high inflation. So it's not deflation. Prices are still going higher. But it's disinflation. They're not going up as fast. And that's what's caused everybody to start thinking that the Fed no longer has to raise interest rates. So they confuse disinflation with deflation. They think that there's deflation going on. There isn't, not anywhere. And it's what we're seeing is a lot of disinflation. So the inflation rate is slowing down, but it's not deflating. Prices are not coming down. It's just not going up as fast. So there's a significant risk because of people getting rid of the US dollar. There's a significant risk of a bigger spike in inflation in the coming months into 2025. And that begs the question, why? Why would all these people getting rid of the US dollar cause inflation to come back? Well, remember, as I said just a second ago, commodities are bought and sold in US dollars. So and when I talk about commodities, I'm talking about things that people buy because they need them. It could be gold. Now, gold is mostly, a lot of people think of it as just an investment, but computer companies or manufacturers they use gold in their connections and all this stuff. So there's actual real world business uses for gold, but it also includes silver and platinum. So all of these things are bought and paid for in US dollars. So as the value of the US dollar comes down, the cost of those things has to go up to make up for the shortfall in the US dollar. So as the dollar comes down, gold has to go up. Oil has to go up. So all of these things will start going up in price because it's going to take more dollars to pay for them. Unless somebody has gotten into an agreement where they're going to buy something for, with something other than a US dollar. And like I said, China, Russia, India to some extent is already doing it as well. India is probably going to be the largest economy in the world in the next 15 years. There's a lot of people there, and they're coming out of they're coming of age, if you will. They're really becoming a powerhouse in the on the Asian continent. They're actually threatening the Chinese to take over number 2 place in the world economy, and it won't be long before they do eclipse China, and of course they're going to eventually eclipse us as well. China will also eventually eclipse us as well. We're probably going to be number 3, possibly number 4 economy in the next 40, 50 years or so. Sad, but mostly because it's the incompetence of the politicians in the United States. But that's another talk for another day. When commodities are bought and paid for in US dollars, as those dollars become less valuable, it would take more dollars to buy stuff. So let's look at a chart of gold. Now, gold is the inverse of dollars, by the way. So this chart is actually the opposite of the chart I just showed you on the value of the US dollar. As the value of the US dollar goes up, the value of gold comes down because it takes less cash, less money to buy an ounce of gold. But when the value of the dollar comes down, again, you start having to pay more money for the same amount of gold. So we're starting to see that. You can see where the value of gold or the price of gold is starting to come up. It did come down a little bit, mostly because most investors were waiting for some of the PCE information and CPI information stuff. So there was a period of time where the markets and gold did come down a bit, but they're on the way back up. So you can see they hit a high almost to 2,100 at one point. They're just under $2,000 now at 1960, and this is as of Friday. So gold's at 1960. I have not looked at it in the last day or so to see if the price of gold has changed. But still, it's right around, let's call it $2,000 an ounce. I think it's going higher. Now, there are some people out there saying maybe 2,500. I think that's I'm famous for saying a bridge too far. I think that's a bridge too far. I don't think gold is going that high, but I do think it's going to get back up into that $2,100 range. What does this mean for example, another commodity, oil? So when you think about oil, oil does the same thing. Oil is not directly an inverse relationship to the US dollar, although there is a relationship. So again, as the value of the dollar falls down, the price of oil has to go up. Because again, if I'm a country, if I'm Britain and I want to buy oil from Saudi Arabia, I don't buy that oil in British pounds, I have to buy it in US dollars. So Britain has to take buy a whole bunch of US dollars through their banking system, and then they give that to the Saudis. And the Saudis come along and say, wait a minute, the value of that dollar is only, let's say, and I'm just going to make a number up, the value of that dollar is only 95 cents. It's not worth $1 anymore. So for every barrel of oil, you have to pay us $1.05. So Britain actually has to pay an extra 5 cents per barrel of oil just to get even, break even on the $1 barrel of oil. So at the end of the day, it takes more money to buy a barrel of oil. So Britain has to come up with an extra nickel for every barrel of oil just to cover the cost of that barrel because of the devaluation of the US dollar. So we're starting to see some movement in oil. Now, I didn't have a time. I'm actually taking a trip. Don't have time to do an oil chart, but oil is now officially out of backwardation. And I'm not going to get too complicated here. Backwardation just simply means that the front month is higher than the forward months. So the month, for example, oil might be, let's say $60 a barrel today, but a barrel of oil 2, 3, 4 months from now might only be $50 a barrel. That's called backwardation. It means the markets are kind of going backwards, and that's why we call it backwardation. And it has been in backwardation for quite some time, but that's not true anymore. the opposite of backwardation is something called contango. So the oil market is in contango right now. That just simply means that the current price of oil is lower than the future value of oil. So the future value, now the current value of oil or price of oil as of Friday was about $72. That's up a little bit from the previous week. The previous week it was at $66 a barrel. So it's moved from $66 a barrel up to $72 a barrel. But if you go out a couple of months, it's not even $72 a barrel, it's $83 a barrel. So the value or the price of oil is going higher. Now, there are some who think that it's going to get up to the 120 range like we saw a couple of years ago. I don't think it's going to get that high, but I do think we're probably going to get to $100 a barrel probably by the end of the year. Now, there's a lot of reasons for that. It's not just the fact that it's in contango, and it's not just because the dollar's losing value. There are other issues. So, Saudi Arabia is trying to force the price, and not just Saudi Arabia, but all of the OPEC countries are trying to cause the price of oil to come up. So they're starting to reduce the amount of supply of it. So they're not selling as much oil because they want the price of it to come up. Remember, supply and demand. The less of something you have, the higher the price of that thing is going to be because there's not as much supply. And assuming the demand stays the same or increases, then the prices of that thing have to go up. So OPEC is going to be, and has actually already done it. Russia announced 2 weeks ago that they were going to reduce the amount of oil they put out. They're a large oil exporter. OPEC has also agreed to those caps. So some of the major players in the oil markets have decided to lower their output. Well, that's going to help, along with the fact that the dollar's losing value. That's going to kind of force oil significantly higher. So I think it gets back to maybe $100 a barrel towards the end of the year. If it does, and I'm convinced it's going to, if it does, what does that do to the inflation in the United States? It's going to reverse it. So what's going to happen here is if oil is one of the biggest expenses we all have in terms of our family expenses. Most of us still don't have electric cars. Most people still drive a gas engine, and we have to buy gas. And gas is going to come back up into the $4.50, and in places like California, it might get back into the fives, mid fives and sixes, and even higher potentially. So those are things that are going to happen. Of course, when oil prices go up higher, food prices go up higher because food has to be transported, and it takes fuel and diesel gas and stuff to do all that stuff. So these are things that are kind of reverse the disinflation we've been seeing. And we're kind of probably get back into the inflation realm. So I personally don't believe that it's time yet to jump back into the market because there's a good solid case that inflation is going to come back. So at this point, what does it all mean? Now, while we can't know the future for certain, we can deduce the falling dollar will bring higher prices to gold, oil, and other commodities. We're already seeing it in food commodities, by the way. Corn, wheat, some safflower, some of those things are already higher priced, and again, they're kind of in contango as well, thereby forcing inflation higher. If you add the unprecedented budget deficits that we have from the White House and from the economy and stuff, interest rates have to go higher. And as interest rates go higher, stock prices have to fall. Now, stock prices have been going up, even though the stock price or the interest rates have been going up lately. But that's only because there's a lot of optimism in the market that the Fed is going to stop this month. Now, they may, I don't know. But at the end of the day, you got to realize interest rates, the Fed rates, is still at 5.25. I don't care what kind of economy you have. When you have interest rates at 5.25, and remember, that's just the Fed funds rate. That's the overnight rate between banks. That's not the lending rate that banks do us, on credit cards or home loans or any of those things. You always add a little bit. So, if you've got let's say you're going to do a car loan is usually 5 to 10 basis points higher than the Fed funds rate. So you're looking at automobile, loans at maybe 12 to 15%. So at the end of the day, this is going to cause inflation to start going up again. So you have all these deficits take money out of the real economy, and it forces us to pay to continue to fund the government. And the higher the deficit, the higher the interest rate, the higher the payment is on that debt. Remember, the United States, in their stupidity, the government of the United States, they don't pay off their debt. They just roll it over. So we're still paying for debt that we took out 30, 40, 50 years ago. We're just rolling it forward. So they pay off and it's no different than somebody who pays off an old credit card with a new credit card. So all they're going to do is pay off the old card by getting a new card, taking a cash loan on the new card, and using to pay off the old card. Well, you still have the balance on your new card now. Then the hope here is that maybe the new card has a lower interest rate. And that was true for most of the time since about 2008, because interest rates had been roughly at zero since 2008. So the government could get away with it. They can't get away with it now. So when interest rates are at 5.25 and potentially going higher, the debt that the government has to service is going to take ever increasing pieces of the revenue that the government brings in through taxes and stuff. Right now, the government brings in about $4 trillion a year in revenue, but they're spending about $6 trillion. So there's a $2 trillion difference between the amount of money coming in versus the money going out. And if the interest on that debt goes higher, it might be that they've got $4 trillion coming in and maybe got $7 trillion going out. And now the deficit's $3 trillion. And now you're just going to start to get into a position where the United States government goes into bankruptcy because, and they're not legally able to, by the way, which is kind of an interesting thing, but they're not going to be able to pay the debt at some point. And what does a country do when they do that? And history shows that every time a country does that, where they get to the point where they just don't have enough money to pay the debt, they just start printing. And that makes inflation even worse, and it compounds the problem, and ultimately that economy blows up. I'm not saying it's going to happen to us. Maybe somebody's going to fix it. I don't see it on the horizon. I don't think, especially with Social Security, what's going to happen with that in the next 5 years or so. So it's going to get even worse as we go forward. So for those of you who are asking, is it time to go all in on equities? I don't think so. So I'm not saying there aren't some good stocks out there to buy. We've been recommending some lately for my clients. We put Eli Lilly out there. That stock has done fabulous. Nvidia, it's a stock I've owned for a long time, and I think I bought that originally in 2011, 2012, and I recommended it for my clients at the time. That was one that I never really sold, but that's a good stock also. Even at today's prices, and it's high, and I get you that. I give you that. It's high. Apple's the same way. It's a good stock, but it's overvalued right now based on where we're at. But 5 years from now, 10 years from now, it's not going to be overvalued. Same thing with Nvidia and stuff. So there are some stocks that are good stocks to buy out there, but it does not mean go out all in. I'm hearing people, just buying the S&P market or buying any of the other markets, the NASDAQ market through the Qs or whatever. I think that would be problematic. You don't put all your money in the market right now, simply because the market is going to correct, I think. Whether, again, how quickly it corrects or when it's going to happen, I don't know. I don't have a crystal ball. But I do want to caution you, it's not time to go all in the market. If you're young and you're a long way from retirement, you can take more chances and more risk. But if you're older, if you're my age, I've got a birthday coming up this week, and I'm going to be 61 this year. So as I get to 61, I start thinking, I've got to make sure that I can still retire. I don't want to lose a lot of money before retirement stuff, so I need to be a little bit more cautious, or at least thoughtful about what I do. But so the older you are, the more cautious you have to be. So I think if you're older, don't jump all the way back into the market. Be very selective on the stocks that you pick if you're going to get into the stock market. And of course, part of my job is to help you with that. So if you have any questions about what stocks and stuff, just drop me a line and I can help you with that. But anyway, that's the meeting for the day. Hope you enjoyed it. And for those of you who are on the calls, we'll see you on the calls. And for those of you otherwise, we'll see you in the meeting next week. So all in all, good week for good week for us last week, and hopefully we'll have another one this week. So we'll see you guys later.